Hello, Steve here again from Student Loan Insider, and today's post we're looking at is will consolidation save me on interest? So, for federal consolidation loans, which is what we're going to look at here, which will be totally different than anything private. If you're looking at a private loan, generally speaking, they'll go by whatever the bank's rules are, and they'll have different rules, and every bank is different, so you certainly should ask them. But for federal loans, interest is done on a weighted average, rounded up to the nearest eighth of a percent. I'll go through the explanation here in just a moment, but what I always tell people when I'm talking to them on the phone is basically if you have two loans, one is $6,000 and one is $4,000. And so the one with the $6,000 would be 60% of the formula. The one with 4,000 would be 40%. So let's say it's like 4% and 6%. It would be 4%, 4%, 4%, 4%, 4%, 4%, six times. And then I think I said six was the other one, 6%, 6%, 6%, 6%. Then you add those all up and you divide that by 10. So that's where your weighted average would come from. Now the calculation itself will be on the article, which will again, as always, will be down below here. And it's kind of an interesting formula, but here's the key to it. Because it's a weighted average and because it's run up to the nearest percentage point, oftentimes you either break even or don't save any money at all. You actually lose money. So let's go ahead and look at some examples. Like I said, you can actually review these examples and the calculation on the post with the blog down below. But let's say you have one loan is 6,000 at 4.5% interest, one loan is 3,000 at 6.8% interest, and one loan is $1,000 at 3.2% interest. So we'll go ahead and do the math. 6% times 0.045 is $270, 3,000 at 6.8% is $204, and 1,000 is $32. So basically, what comes down here is the daily interest before, and again, just to back up a few steps, you figure out daily interest by multiplying the interest rate times the principal balance divided by 365, and interest does accrue daily. So it was 139 before you consolidated, and now after consolidating is $1.40. So as you can see, it actually went up a penny a day. Because the weighted interest rate in that scenario was 5.125, which again, I can kind of go, if you look at the post, it'll show you how that's figured. Now, another example, now obviously the largest amount was at the highest, or actually the middle of the road amount was at the highest interest rate. Now, if you go where the highest amount is the lowest interest rate, so one loan's at 6,000 at 3.2, 3,000 at 4.5, and 1,000 at 6.8. If we do the math this way, it's actually even more in the favor of not consolidating. Daily interest would be 110 before consolidation, 108 after. So basically, what we're going to showing here is that consolidation may not always work. Now, I'm sure if we ran a lot more examples, we're going to find an example where, especially if you have a really large loan, like say $40,000 at 4%, and a really small loan like $5,000. These were all close amounts that would not skew it as much. But the general idea behind it is that it's not, you have to definitely look at it before you decide if consolidation is right for you with the interest. Just thinking you're going to save on interest is not necessarily going to always help you. So hopefully this helps out overall. If you have any questions at all, go ahead and feel free to contact me. My email is actually studentloaninsider@gmail.com. And I'll be more than glad to help you out with whatever you need. Hope this helps, and you have a great day.